Okay, so I appreciate you guys filling this out. It looks like this is a wonderful opportunity to introduce you to the Kiavi team and Hunter. Many of you have TurboTenant accounts, which is great, and a good split of people who have attended a webinar with us in the past versus not. Thank you so much for spending some time with us today. We are thrilled to talk to you. So to kick things off, as we mentioned, we have the incredible Hunter Lotta here with us from Kiavi. Hunter, would you like to introduce yourself to the audience?
Yeah, thanks, Krista. So I've been here with Kiavi for about a year and a half now. My background is solely in private lending. Worked for a few different lenders in the past, but been doing this for about 6 years now, 6, 7 years, and has again solely been in kind of the private lending space, so hard money loans or private money loans. So looking forward to helping educate some of the folks that have not heard about Kiavi and help educate folks that are not as familiar with hard money loans and kind of how those work and the different types of options that are out there. I think we can just go ahead and jump right in. Next slide, Julian. Thanks. So we're gonna dive in and kind of talk high level about kind of what types of hard money loans are out there, and then we'll dive into kind of Kiavi, different exit strategies, et cetera. So next slide, please. And I believe we have one more poll for you here, Krista. Thank you.
Absolutely, we do. So we are curious how you currently fund your real estate investment portfolio. Please feel free to select all that apply. So you are not limited to one choice. If you have an other option, we would love to see you share that in the chat. Okay.
I'm going to jot down some notes as we're kind of some of the concentrations here so I can kind of touch back on some of these throughout the conversation that we're going to have today. Looks like a lot of folks have done traditional mortgages, which is good. Looks like some folks have done some bridge loans.
Yeah. Also got some DSCR and VA loans in the chat along with private money.
Let's call the bridge loans kind of private money or hard money loans in the past. If you haven't selected one or haven't selected that bridge loan and have done private money loans or hard money loans, go ahead and select that option.
Fantastic. All right, folks. Yeah, we're on the same wavelength.
Yeah,
a little bit of time. Okay. And let's show these results here. So as you can see, lots of traditional mortgages, nothing wrong with that. But I'm so excited for you to learn from Hunter today about other options at your disposal.
Cool. Okay, so I'm gonna dive on in. So you have a whole lot of different options in financing real estate deals, which I'm sure a lot of you are familiar with. So you can, of course, self-fund them, i.e. all cash. You could use hard money or private money lenders out there. Hard money being kind of like the Kiavis of the world, the lenders that are a little bit more institutional than kind of your rich uncle or rich aunt that maybe is kind of more private money that, you know, they stroke you a check. They don't have a lot of guidelines. They just know that you've been investing in real estate and are willing to cut you a check type private money lenders. Then you've got traditional banks, which is kind of your conventional financing routes that are Fannie, Freddie, or just bank loans in general. Then you've got self-directed IRAs. And then for those of you that are potentially have sold some real estate and are 1031 exchanging into your next investment property, you have a 1031 exchange vehicle as well. So those are the typical traditional different routes that people take. And we're going to dive on into some of these. So next slide, please. So for Kiavi specifically, you want to know, like, what are your requirements? So I'm going to read through these kind of bullet by bullet, and then the rest of the slides, I'm kind of going to just be general and high level. I'm not going to go bullet by bullet and kind of just touch on the main points. So feel free to toss questions in the Q&A. Feel free to toss questions in the webinar chat. I'm going to pause strategically here and answer some of the questions, and some of them we're going to save for kind of the Q&A here. So this will take about a half an hour for the presentation portion. We'll leave about a half an hour for Q&A. So Kiavi requirements are, we are a business purpose lender. And what that means is that we lend to investors. We do not lend to folks that want to buy a property for the purpose of living in it themselves. So that would be an owner occupant loan, kind of a traditional agency backed loan. Sometimes bank rate loans are owner occupant loans. So business purpose loans is going to be the first and foremost bullet here. And then we only lend to entities. We do not lend to individuals. So we lend to sole proprietorships, LLCs, corporations, different types of entities. And then we have a minimum FICO score of 660. There are some down payment and cash reserve requirements, which we'll get into in a little bit. And then we service different types of business plans or exit strategies here. So we have buy and hold investors that we work with, fix and flip investors that we work with, and then sometimes short-term rental investors that we work with as well, as among other different types of strategies that are out there. But those are some of the primary ones, the primary different exit strategies. Go ahead and jump into the next slide, please. And then so a few different options of when you can use a hard money loan. So you could use a hard money loan for, say, a rental property, both for long-term and short-term rentals, as well as a fix and flip loan. And then for commercial multifamily properties for at Kiavi, at least, you could certainly use a hard money loan for other asset types or other business plans. But these are the kind of the primary ones that we really focus on. And so rental loans, you could, or for rental properties, you could use a bridge loan to take down that property in a short term or a short closing runway there. So you need to close a loan in less than 30 days. A traditional rental DSCR product might take you a little bit longer to close that. Bridge loan might be a great execution for you. And then you can say you need to do some rehab to it, do that work that needs to be done, and then put a new tenant in place, and then prepare yourself for a long-term rental loan, which would be kind of our DSCR products, which we'll kind of break those down a little bit in later slides here. You've got your fix and flip, so that's pretty straightforward. That's buying your distressed asset, rehabbing the property, and then putting it back on the market. It's a great execution for a hard money loan. And then you've got, as I mentioned, the multifamily property. So same kind of concept as you buy a distressed asset, you need to rehab it, you need to put more tenants back into place, and then ultimately get yourself ready for a long-term loan with maybe an agency lender, a local bank, etc. So I'm going to stop here. Do we have any? Let's check out the chat. Any questions we can cover here? Chris, did you see anything?
I think so.
Yeah, go ahead and shoot them off.
Perfect. So Teresa is curious why you would look at FICO if it's a loan to a business entity. And if there are partners on the deal, do you use FICO for all of them?
So we look at FICO because while we're still lending to an entity, there are still people controlling that entity behind the scenes. We're going to look at the FICO of the guarantor of the loan, not all of the different partners in the entity. Some lenders look at all of the partners or have a requirement if they own a certain percentage or more that they are going to pull FICO on all of the borrowers, but we look at just the guarantor. And there's a strong correlation between FICO history and delinquency rates when you get in kind of, if you zoom out at like a super high level and look at across all of the industries, all of the mortgages ever originated, there's a strong correlation between high FICOs and low delinquency rates and lower FICOs and higher delinquency rates. There's a lot of other factors that go into it. We have a ton of data behind the scenes that we look at, that we have access to over doing 50,000 some odd loans in our history. But that's kind of at a high level why we look at FICO of the guarantor in a business purpose loan.
Well said. On that FICO train, Lisa is curious, for FICO scores, are you using a person's individual or the company's EIN number?
We're using the person's social security number to pull FICO.
Fantastic. And Jen is saying or asking, the highest FICO tier is just 740 plus, correct?
Ours is 750 plus, I believe, on the bridge loans, but it's different for different product types. So for bridge loans, you might have different buckets of different hurdles for the FICO, and for long-term DSCR products, you could go all the way up to say 780 or 800. Usually it's every 20 every 20 points on FICO, for us at least, is a different pricing bucket on, say, a rental product. But that's kind of getting a little granular. I would say that's kind of a conversation you want to have on a one-off basis with your loan officer.
That makes sense. Okay, and Cordell requests that we define acceptable cash reserves. Does it have to be money in a checking or savings account, or do you consider investment accounts, 401ks, etc. as well?
So typically it's cash for us, at least. In some instances, we can make exceptions for if it's liquid assets, so investment accounts, 401ks. There are some instances where we can account for that as well, but we can dive into that a little bit further, kind of in the Q&A. We can unpack that a little bit more.
Perfect. Okay. And just like he said, we will be coming back to these questions. So I'm making notes. Please continue to keep them coming, but I think that is about what we have right now for this slide.
Yeah. Let's keep moving. I think we actually moved backwards. There we go. Let's go one more slide forward. Thank you so much. So hard money pros and cons here, what we're going to cover, but the pros first. You've got quick closings, you've got easier applications, easier underwrites typically as well. And then you've got flexible terms, i.e. maybe a 24-month bridge loan, or on a rental product, you might be able to kind of play with the levers a little bit, shorten your prepay, increase your leverage, do buy downs, etc. There's a lot of different flexible terms that we can offer that help you kind of achieve your business plan. And we're going to talk about business plans and different exit strategies here a little bit more in depth in a minute. And then on, say, our bridge loans, we offer interest-only payments. And then on our debt service coverage ratio, or DSCR products, and our 30-year products, we also offer some interest-only. So that kind of is a nest underneath that flexible terms bucket there. But to touch a little bit more on fast closing and easy applications versus, say, like a bank, for example, bank underwrite's going to be a lot more excruciating with the amount of diligence they're going to ask for. They're going to do a full underwrite of your tax returns, your bank statements, your personal financials. They're going to kind of go in and dig in real deep and have a lot of questions. That process takes a long time. So if you need to close quickly, say you've got a 30-day escrow or 15-day escrow, a hard money lender is going to be your better route, because they're going to be able to close faster. They're going to have easier applications. Kiavi, for example, we don't dig into tax returns, bank statements, personal financial statements for our bridge loans. So it's largely focused on an asset-based loan and focusing on the project itself. And that's what we're looking at when we're underwriting a bridge loan. Next slide, please. So some of the cons, right? Like hard money, like we still require some form of down payment. So that's anywhere from 10 to 35%, depending on the type of project that you're doing. And that is kind of touching on the cash requirements question that came up a little bit earlier. So you're going to need to have at least that much money in cash reserves in your bank account, because you're going to need that for the closing, right? And then we're going to require that you have some liquidity to cover the payments during the duration of the loan, right? So we won't get into all the nuts and bolts there, but that cash reserves requirement is important, because you're going to have some down payment, you're going to have some debt service that you're going to need to service, and then you're going to have potentially rehab that is revolving in and out of that bridge loan. Sometimes or typically hard money is going to be higher interest rates than, say, your bank rate financing. We had a large population of people on that first or that second question that said they've done traditional financing. Agency-backed financing, traditional financing, is going to be the lowest rate that the market has to offer for long-term financing. But that's kind of the trade-off, right? Like if you go through that excruciating underwrite and you can get all the way through to the finish line, you get a pretty good rate, but it takes a long time to get there. So sometimes for some folks, the higher interest rate is worth it to them to be able to kind of more efficiently move through the loan process and focus more on buying additional real estate and stabilizing additional real estate. Maybe that be for fix and flip or for long-term rental. And then for hard money, sometimes they have prepayment penalties in there. So on our DSCR products, for example, we have prepayment penalties that are structured in here. And then on our bridge loans, we don't. To be clear, that we do not have prepayment penalties on our bridge loans, but those are at a high level some of the cons here. I've covered a lot of information there. I see a bunch of questions popping up in the chat. Krista, do we have any that we feel like we want to cover here, or do we want to kind of move some of these to the Q&A section?
Yeah, great question. So I'm going to let the questions about Kiavi specifically wait until the end, because we're going to cover quite a bit of that. But I do see Erica is asking, how is the down payment percentage determined? Is it based on the funded amount, credit score, etc.?
We do have some requirements in there for if you have a lower FICO, that we cap at a certain percentage of the purchase price. But down payment, we go up to say 90% of the purchase price, so the 10% down payment there, and we can go all the way down to say 65 or 70% of purchase price to kind of control the different levers there on down payment. That's going to impact the higher the LTC or the financing on the purchase, the higher your rate's going to be, because the overall LTC of the project is going to be higher. There's what's called risk adjusted pricing that we do. So if the higher LTC is a little bit more risky, so a little bit have a higher rate. If you have more skin in the game, common term that you'll hear in the lending space, i.e. more money in the deal, then you'll get a better interest rate.
Nice. Okay, and JW is asking, what is the standard prepayment penalty, and is it negotiable?
So we'll get JW, we'll dig into that a little bit further, kind of when we get into some of the comparisons between the different product types. Like I mentioned, we have a few different DSCR products, but it's typically a step down for Kiavi, and we'll unpack that a little bit further in the later slides.
Wonderful. Okay, let me do one last sweep here. Let me know if we're going to cover this as well, but David is asking if the seller can provide the second note and credit buyer for CC.
For closing costs. Got it. I'm assuming that CC means closing costs. So we do allow for seller seconds on the bridge loans, but they need to, there's a lot of, there's some requirements there. So I would recommend talking to your loan officer. That's kind of a specific scenario. Like I said, we have some requirements around that. So it is allowable, but we definitely need to explore that a little bit further on a one-off basis to make sure that we're doing this right for you.
Well said. Okay. And then a lot of this we're going to cover, or we will circle back to it when we talk about Kiavi specifically. So I think we're safe to move on.
Cool. Thank you. Okay, so different financing strategies. So we're going to talk about a handful of different exit strategies. And I think we have one more slide or question coming up. Is that correct?
Indeed, you are correct. So please select all the strategies you're currently using as a real estate investor. And if you're not yet an investor, we have included an option for you. Please don't feel embarrassed about selecting it. Knowledge is power, and that's what we're here to do. So please select everything that you are currently using. Okay. What does single asset rental mean? Great question. Same question from Jen. That is fantastic. I know we're going to touch on it in a second, but Hunter, if you want to explain.
Yeah, single asset rental is, I guess, would nest underneath that long-term rental. So if you're investing in single asset rental, you're effectively doing long-term rental. And we'll kind of unpack what that product means to Kiavi here in some of these upcoming slides here. We're going to talk about different exit strategies and then a comparison of different product types that Kiavi offers, as well as kind of a little bit more about Kiavi at a high level.
Wonderful. All
Looks
right.
like we've got a lot of answers on this one. Good engagement. 80% of us are long-term rental operators. 20% are short-term rental. Got some BRRRR folks in here, and then fix and flips. And then we've got a few folks that are new to the game, and that's okay too. That's what we're here for, is kind of learn as much as we can and jump on in. So let's go ahead and jump into the next slide then, and let's start unpacking this. So I gotta get this poll off my screen so I can see the slides. Here we go. Okay. So first exit strategy here is long-term rental, right? So when you're when you're investing, obviously you want to think about, if I'm buying this property, what is my long-term strategy with this property? Is it to hold as a rental? Is it to hold at, or to fix and flip? Is it the BRRRR method? It needs some rehab. I want to put a tenant in place and then take some money out, repeat the process. Or it could just be you're buying a straight up occupied property. It's that has a tenant in place, and I want to hold this property. I like the numbers. It looks good. Like let's buy this long-term rental. So the first strategy here for long-term rentals is a great way to produce positive passive cash flow, especially if you're using a third-party property manager or have an in-house person that manages kind of the day-to-day of the management. Maybe you own your own management company. It's a great way to produce positive passive cash flow. We have multiple loan programs available to help service the long-term rental. One of the options on the previous question was single asset rentals. We have a single asset rental product, and what that really means is one loan to one property. So as you are maybe stabilizing a property and it's ready for long-term financing, then you could apply for, say, a single asset rental loan. It's a 30-year product. Typically, we have some ARM products as well that are kind of that are classified under that single asset rental product. But so you have single asset rental products, and then we also offer a portfolio loan product, which is 5 or more properties wrapped up into a single loan, which is then closed as a single loan versus potentially 5 single asset rental loans or multiple single asset rental loans. And then long-term rental products are largely driven, FICO or rates are driven by FICO and leverage. Those are your two biggest levers typically when you're talking about interest rate. There's some other smaller things that play into it typically, but those are your two big ones. So if you're rate sensitive and you have a strong FICO and you want to bring that rate down to something a little bit more palatable to you, and you're at, say, 75% leverage for your current request, maybe dial it back to 70. That'll help you out on the interest rate. That'll bring it down a little bit. Same goes for, if you're on at 60%, you want to take a little bit more leverage out. You don't care about the rate as much. You want to get your cash out so that you can buy more real estate and produce more cash flow. Then maybe take a little bit of a higher LTV. All of these long-term rental products are going to be kind of pass-fail tested by what's called debt service coverage ratio, DSCR for short. For those of you that aren't as familiar with it, it is the debt service coverage ratio is calculated by net operating income divided by annual debt payment. And our products have different requirements. So the single asset product is a 1.10 debt service coverage ratio requirement, and our portfolio products are 1.20 debt service coverage or greater. So let's go ahead and jump into the next slide. We're going to save kind of the Q&A here kind of towards the end of this section. I'll pause and we'll have we'll answer some of these questions. So your next strategy here is short-term rental. Really great, really popular investment strategy. It's typically generates more income than a traditional 12-month lease. You're charging per night. You're having tenants that are staying, maybe 1 to 2 nights. Then you're turning that property over and getting somebody else into that property. Very important with this exit strategy or business plan to understand the market conditions and the demand drivers. And what I mean by that is what are your draws for short-term rental? Like, are you near a beach? Are you near a ski resort? Are you near, Disneyland or Disney World, for example? Those are going to be strong demand drivers for your short-term rental. And then you need to think about too the market conditions. If that demand driver starts to drop and there's not as much demand for short-term rental, what are your market conditions as potentially a long-term rental? Does this pencil out? Does this deal make sense still if I have to put a 12-month tenant in place to kind of offset the short-term or the decreased demand for short-term rental? Next slide, please. And so we've got different different strategies here. So you could use a portfolio loan versus single asset loans. And one of the differences from portfolio to single asset is that portfolio, we can offer what's called non-recourse. On the single asset loans, they're all full recourse or personally guaranteed. For most of the folks in the room that have done traditional finance methods, you've probably signed for a personal guarantee or full recourse through those Fannie Freddie or bank type loans that are kind of fall underneath that traditional financing method. One payment versus multiple payments. Say, back to the example I gave earlier, if you have 5 properties and are doing a portfolio loan, you're going to have one payment, one closer, one underwrite versus having 5 payments, 5 different potential servicer or at least servicing account numbers to keep track of, and then 5 different closings, right? So think about signing all those different lines 5 different times. Like you're gonna have your hand's gonna have carpal tunnel once you're done signing all those different closing docs. Now, there's a little bit of an economies of scale with portfolio as well. So a little bit cheaper on the fees, typically a little bit more efficient to close the loan. It's a little bit better interest rates. There's some economies of scale there, but the trade-off is for some folks, you might not acquire 5 properties fast enough for it to make sense for you. So a single asset product might be great because maybe you do a couple a year, you do one, onesie twosies a year, or maybe you do just barely 5 in a year. Like with where rates are today and how fast they've been moving, it might make more sense to just do that single asset loan. But if you're acquiring at a high capacity or high scale, portfolio is a great execution for you. Let's go ahead and jump into the next slide. So here's the BRRRR method. You could do this at scale, or you could do this on a individual property basis, which is the buy, renovate, refinance, repeat method here. So very common amongst real estate investors. A fun key call out here is that the BRRRR method, the cash proceeds from the refinance, as some of you are probably familiar with, is tax-free, right? Like that's why everybody loves BRRRR. Like you force the appreciation into the asset, you take your cash out and you roll it into your next investment, and that cash out is tax-free. So again, you go into this method with that exit in mind, right? Like you back into the numbers on the purchase using, if I think it's worth this at the end of the business plan, and I put Y dollars into it, I can only purchase this property for X amount to make this make sense. And then another thing to keep in mind when you're doing a BRRRR loan is that your exit strategy is a debt service coverage loan typically. So you need to run your numbers. Does this loan make sense if I think the value is say it's 175,000 once it's complete, and you rent it out for the market rents at today's interest rates? Am I meeting my lender's DSCR requirements based on my numbers on the front end? So then you have a certainty of execution on the long-term takeout. So you want to kind of back yourself into where you need to be on the purchase based on where you want to go. Let's go ahead and jump into the next slide. Perfect. And then for the final business plan here, fix and flip and bridge loans at a high level here. Kind of the goal here is to pay as little upfront as possible in the form of points, fees, cash in, et cetera, typically for a lot of borrowers, especially newer borrowers. And a bridge loan or hard money loan is going to be great for that. You want to prioritize your costs, sometimes more than leverage, then that you have that option as well. And then you want to pay attention to prepayment penalties. Sometimes some lenders have a minimum hold period or minimum interest period on their bridge loans. So that's something to keep in mind. And then you want to be realistic about your time to exit, your loan term, and understanding what are your lender's extension costs. So if you think that maybe it's going to take you 8 to 9 months to do the project and you're looking at a 12-month term, it might make more sense to take the 18-month term right out of the gate if their extension costs are a little costly to get there. It might make more dollars and cents mathematically to take that 18-month term and give yourself a little bit more runway. you want to think about all those things when you're looking at a fix and flip or a bridge loan. So let's go next slide, and I'm going to pause there. We'll do a couple questions. I've seen a lot of things popping into the chat. So let's go ahead and Chris, do you want to hit me with a couple of these, and then we can unpack some of this?
Absolutely. So first off, how do you qualify for a portfolio loan?
The portfolio loan is going to be 5 or more properties, minimum loan amount of 500,000, and a minimum property valuation requirement of 50,000 or greater. Those are kind of the key 3 requirements. They're all multiples of 5 that get you kind of started on a portfolio loan.
Fantastic. To that end, can multiple single asset loans be rolled up into a portfolio loan?
No. Short answer is no. If they've already been originated, they're kind of already set. They've got their prepayment penalties. If you're outside, say they're older single asset loans that you've closed years ago, you could certainly refinance those into a portfolio loan, kind of consolidate your debt. That's very common with lenders to or with investors to kind of consolidate debt. With traditional financing, I haven't touched on this point yet, but with traditional financing, you typically cap out at 10-ish properties as a max. It's all based on your debt to income ratio. But Fannie Freddie guidelines cap you, I believe it's at 10 off the top of my head. And so what we can do is refinance those properties that are on traditional financing. I call it clearing the deck, kind of refinance those traditional financing properties into either our single asset product or a portfolio loan, for example, and you can go out and rinse and repeat again. So it kind of, yes, you would, in today's environment, you'd probably be increasing your cost of capital, your interest rates across those properties would increase, but that would also open the door for you to go out and acquire more properties at the cheapest rates in today's market. So your weighted average cost of capital will move up, but you're able to go out and acquire more properties. So it's a bit of a trade-off, but something that we do regularly for investors.
Wonderful. For a portfolio loan, can I have 5 of them under different LLCs, or will they all have to be under one LLC?
So they would all be underneath one LLC. And without diving too much into kind of org structures or entity structures, they would need to be under one LLC. I'm happy to, I see that Anne asked that question, happy to find some time and to kind of dive into that a little bit further on a one-on-one call.
Wonderful. All right. Another portfolio question, just to clarify, David is curious. The portfolio loan must be 5 or more and be under contract for the one for all loan product. Sorry. Yes, I think he's saying, I'm not answering the question, but I'm going to rephrase it so Hunter can answer it. So the portfolio loan must be 5 or more and be under contract for the one for all loan product.
So I think what he's asking, if maybe there's a purchase question in there that's kind of hidden in there. I'm not quite sure what he's getting at. They are underneath one application, one loan underneath a portfolio loan, and one underwrite, et cetera. So that's kind of the point of a portfolio loan, is to kind of simplify the underwriting process. But if there's an acquisition in there, which we can do on the portfolio loan side, there's definitely some more stuff to be talked about there. So maybe Dave, we can connect after the call here.
Lovely. Portfolio loans are very popular. So Ivan is asking if the 5, that magic number 5 for portfolio loans has to be 5 properties or 5 doors.
So it's going to be 5 properties for us. Some lenders are 5 or more doors. So say for us, it's 5 or more properties. So 5 or more single families is the easiest example. For some lenders, it might be, say, a triplex and a duplex qualify, but we're kind of the former there, the 5 or more properties.
Delightful. We do have a question on BRRRRs. So can a BRRRR loan involve small amounts for cosmetic improvements as long as the appreciation will still be realized? For example, $10,000 to $15,000 in improvements, or is it typically for a larger amount of improvements? Teresa wants to know.
So the BRRRR method, if it is, can be for cosmetic to make the answer short, but without going too far into kind of BRRRR, like it also comes down to like the buy side too. If you're buying from a distressed seller and it's under market purchase price because they needed to sell it for whatever reason and you have cash, you're able to buy it today and clear up all their issues. Yeah, it might only need 10 to 15K in improvements, but you're kind of you're realizing that appreciation because that person had a problem that you're solving. Real estate is all about solving problems, and sometimes solving other people's problems by kind of quickly closing is a great way to pick up a BRRRR property at a really good price. We see it all the time as on the lender side. You kind of go, I can't believe this is real, but it happens all the time.
Very nice. Okay. I know we have a lot of questions. We are going to get those answered for you as best we can. One last one for now about properties. So let's see, what if the properties are set in individual trusts and you are looking to establish a portfolio loan? Ivan asks.
So kind of back to the LLC question earlier. So that would be, we'd still need them in one LLC at closing, Ivan. So they would ideally be transferred at closing by the title company, and they'll take care of that for you. But they do need to go into one LLC. So I'm happy to find some time and kind of unpack that a little bit further. There's a lot behind that, but happy to find some time.
Lovely. Well, we still have plenty of questions, but we can use them in the Q&A and further on.
Cool. So next up, we want to kind of cover some of the questions to ask your lender. For those of you that maybe haven't worked with a hard money lender before and have done mostly traditional, these are going to be super helpful for you. So let's just go ahead and dive on in. So the first question, if you're doing a rental loan, is like, what are your DSCR requirements? And again, to kind of talk about debt service coverage, that measures the asset's ability to pay its expenses and the mortgage payment. So the greater the debt service coverage ratio, the better. All lenders have minimum debt service coverage requirements. If they're doing rental loans, it's just asking the question is, what is your DSCR requirements, and how do you calculate your net operating income? That's another kind of dovetail off of this a bit and say, like, that's another important question to ask. It's not in the slides here, but how do you calculate net operating income? And understanding that will be helpful so that you can calculate your numbers on new deals that you're looking at purchasing, and helping you understand, like, are my properties that I own today potentially a fit for their long-term rental product? So let's go ahead and dive in. Next slide. How does your adjustable rate mortgages differ from a traditional 30-year fixed rate mortgage? So if you are looking at ARM products, adjustable rate mortgage products, how do they adjust? When do they adjust? What is the index that it's tied to? What's the max amount that it can adjust to when it adjusts? What's the max amount that the rate can go to over time? These are all things that you want to think about when you're looking at an adjustable rate mortgage. And then thinking about, if my rate adjusts to, say, the maximum amount it can adjust to after, say, 5 years, for example, and my rents grow by X% per year over the first 5 years of the loan, like, what is my debt service coverage going to look like then? Am I going to be able to cover my expenses and my debt service? Like, am I happy with those returns in say 5 years if that rate adjusts? And then look at, if I do a 30-year fixed rate mortgage, what do those numbers look like over time? If my rent continues to increase, my payment's going to be the same over 30 years because you're not going to have an adjustable rate. Those are all things to consider when you're talking to a lender about their different rental products. Let's go ahead and jump into the next slide, please. What is your rate lock process? Some lenders offer a forward rate lock at the submission of the loan, and some lenders don't. So you need to understand, like, what is your process if you offer it at all, and understand that process. At Kiavi, we offer on the single asset loans a 45-day rate lock on portfolio because typically it's more properties, kind of takes a little bit longer. We offer a little bit of a longer rate lock of 60 days for the portfolio loans. but it's important to ask that question if they offer a rate lock or not. Some lenders might not offer it, and during underwriting, your rate is subject to market changes. Usually, it's quoted as an index, say the 10-year Treasury plus a spread, or the 5-year, whatever their index is, plus some kind of a spread. And when you get to closing, you might find out that, well, I thought I was getting a X% rate. It's now Y, and Y is a lot higher than what I was expecting. And then that changes your returns on that property by having that floating interest rate during the underwriting process. So let's go to the next slide, please. Then what are your escrow requirements? Some lenders require 3 months of principal and interest, taxes and insurance to be escrowed at closing. Some lenders have capital expenditures escrows that are required. At Kiavi, these are not a requirement, right? Like, we're not just impounding additional principal and interest, taxes and insurance into, like, typically that gets escrowed as a payment reserve on closing statements, but we don't require that. And next slide, please. How do I qualify for your loan? And like, what are the impacts of the terms? So kind of back to the adjustable rate comment I made earlier, in the 30-year option as well. Evaluating the different term lengths that the lender offers. How do I qualify for the loan? So understanding that what are their FICO requirements? What are their appraisal requirements or their value requirements? What do their underwriting process look like? What are their underwriting requirements? Like I mentioned earlier, some lenders, typically banks, require a full underwrite with the taxes, the insurance, and the P&Ls, the bank statements. Like, it can be a lot more arduous to get through that underwriting process with some lenders than others. So it's important to understand those different requirements and qualifications. Perfect. Next slide. And then some of the common pitfalls, right? Like, debt service coverage ratio is a big one. Folks that haven't maybe stress tested their deals when they're purchasing them for kind of a higher interest rate environment like we're in today, where rates are increasing. You want to look at where is my debt service coverage at today's prevailing rate, and then maybe where is it at, say, like 0.5% higher, maybe a full point higher. I mean, the markets have moved so much this year. It's really important to look at, if it's going to take me, say, 6 months to stabilize this property, to get it ready for a long-term rental product, a debt service coverage ratio loan. Like, what do those numbers look like in 6 months if the rates move 0.5 point or a full point? So that's an important one. And then different amortization schedules. So sometimes banks are going to have a shorter amortization schedule. Some lenders in general just have shorter amortization schedules. So your payment on a 20-year amortization, while their rate might look really great on paper, but when you calculate your payment, it might be higher than, say, a 30-year amortization schedule at a little bit of a higher rate. So that's another thing to keep in mind. And then, what are their prepayment penalties? So if they have a longer prepayment penalty, or a prepayment penalty that's a little bit more painful to get out of. Some of them are, like ours is pretty straightforward. It's a step down prepay. In year 1 that your prepayment penalty is X%. Year 2, it's it goes down a little bit. Year 3, it goes down a little bit. And then some lenders have what's called yield maintenance. If you've done portfolio loans, that's a common one, or defeasance if you've done commercial loans in the past. Those are really painful to get out of. In fact, it's typically so costly that it's disadvantageous to somebody to actually get out of that loan before that penalty ends. And then number 4, what does your valuation process look like? What AMCs do you work with? Do you use an AMC? Do you do desktop appraisals? Those are some of the different pain points that borrowers experience with values. What are your requirements for condition of the properties? Appraisers have a condition rating system called it's C1 through C6. Usually lenders have a requirement of C4 or better, which is kind of C4 is your kind of typical average rental property, usually lands at C4. C3 is kind of a C3 and C2 are kind of higher end fix and flips or a year to 2 year old new construction, and C1's usually like brand new property. So those are important to understand. What are your valuation requirements and what your evaluation process look like. And then all that to be said, these common pitfalls, it's important to have a lender that can help you navigate those, help you prepare for those, help you educate yourself on all of these different pitfalls and how to stay out of them. So that's really important too. So I think next slide, we're going to talk a little bit, kind of dive in deeper on Kiavi and who we are, what do we do, the different loan products that we offer that I haven't really touched on yet. And we're just going to get a little bit more granular here. So who is Kiavi? Okay, so we financed over $4.1 billion in bridge loans in our history. We financed over 50,000 projects. We just passed that mile marker recently in the last week or two. That's a great, nice, big round number. When you think about that, that's a lot of loans, a lot of closings, a lot of data that we've accumulated over time and in projects and things like that we've seen. So we've got a huge database in the background that we've learned so much from, that we use to our advantage on learning from that and applying that to make the process better for investors as time goes on. We lend in 32 states plus Washington, D.C., and we're known for, on our bridge loans especially, the quick closings, right? So our average closing timeline, probably about 14 business days, give or take. But that closing timeline is largely controlled by investors and how quickly you provide us the documentation we need, how clean is the documentation, how long is it, like, how well is it presented to us, and we'll get into states that we lend in here in a second. I see those questions popping up here. But yeah, we have really quick closing timelines. And then a fifth bullet that I'll kind of dovetail off of here and add on is that we have a really great tech platform that you can go in, you can self-serve, kind of plug in the numbers and figure out, like, what is my rate going to be for this project, and then choose from there, submit the loan, kind of print off pre-qual letters that you'll typically need when you're putting in purchase offers. And yeah, the tech that you have access to is really, really powerful. Let's go ahead and jump into the next slide. So we've got a lot of questions about the markets that we cover. So all of the markets here in green, or that teal color actually, are the markets that we cover. So we do lend in New Jersey. And then the gray markets are, unfortunately, we're not in those states yet, but we are actively working on expanding to new markets, and those are on the roadmap a little bit further on down the line. Let's go ahead and jump into the next slide. So kind of diving in a little bit more into that closing process I mentioned earlier. So like I said, you can go online, you can submit the deals, you can price them out. You can say, like, if my rehab is X and I think the value is Y and I'm purchasing for X dollar amount, like, you can plug all of those numbers in and get a pre-qual letter, submit that with your offer to make your offer stronger. You can track and manage your loans in flight. You can see where, if there's any conditions that the underwriter needs. You can go in and upload documents in there. You can do everything that you're going to need to do to be able to operate in an efficient way as an investor, without having to, say, pick up the phone, talk to your loan officer, send stuff over email, wait for that pre-qual letter. You can go in and do it all on the system, which is really, really powerful when you're talking about real estate, which moves in seconds and minutes and is very quick, and you need to get those offers out to win a deal. Yeah, Austin, Colorado's good. Saw that one pop up. And then you have a dedicated account manager too, right? So we have a whole team that's dedicated to helping you make sure that you're successful, shepherding the deals through the process, the underwriting process, all the way through closing. And that dedicated team is going to be there to help you make sure that you're successful, kind of be your point of contact. If you ever have any questions, if you ever have any issues, like, they're going to help you navigate that. Let's go ahead and click into the next slide. Then this is, how to get started, right? So, like, how do we work with Kiavi? Saw a couple of those questions earlier on. So there'll be a few ways. So if you go to kiavi.com/TurboTenant, that'll take you to a nice landing page. And then TurboTenant's actually going to put the webinar on their website underneath the webinar section of the website. And then you'll have access to the slide deck. And then you, like I mentioned a couple times, you can go in and into our website, plug in the project number, submit a deal, and that'll get you assigned to a rep, and then it's kind of off to the races from there. But there's several ways to get in touch with us, and we're more than happy to get on a call, answer any questions you have, et cetera, and make sure that you are fully understanding of the process and fully understanding of how we can help you with whatever your project may be. Let's go next slide, which is the live Q&A. I don't know. Can't see a timer on my desktop here. Okay, so we've got about 35 minutes for Q&A. So I saw a bunch of questions popping up in here. Let's just kind of start going through some of them. Krista, you want to just kind of start firing away?
Yeah, absolutely. We have about 5 minutes, so we might do rapid fire round.
Oh.
First off, Janice is curious, do hard money loans get reported to credit agencies? If not, how do you build your business credit to get cheaper options for buy and hold over time?
So we do not report to credit agencies. Some private money lenders do. I guess that's a great question, and a good question to ask to all lenders that you work with, right? Traditional financing is going to report to your credit, right? And credit is not just a function of how many mortgages do you have. There's a whole lot of things that go into it. But getting some of those traditional mortgages off your credit and off your balance sheet into, say, an LLC, into a private money loan will certainly help you out.
Wonderful. To that end, David wants to know, how many loans can you have at once outstanding?
So on our rental loans, we do not have a limit. On the bridge loans, we do have limits to start, right? Like, we don't give you an unlimited source of funds, but you are pre-approved when you get approved for what we call our membership program. We get you approved. You can start borrowing from us. I think that cap is, off the top of my head, it's $3 million right out of the gate. So that's a lot of dollars that you have just to for that basic approval. Then if you need more, say you're buying a ton of properties, you're aggregating rentals, you're buying 10, 20 of these a month, you're that caliber of an investor, we can talk about how to increase that amount, that exposure limit to a higher number.
Wonderful. Quickly, I'll take this one. Will this recording be available? Yes, we will send it to you within 48 hours. So keep an eye on your email. You don't have to do anything else. Marguerite wants to know, how long has Kiavi been in business, and from whom do you receive cash for short-term loans? Also, what's the average duration of your loans?
Sure. So we've been in business since 2014. We receive our cash from what's called securitizations. So we have bridge revolving securitizations that we have established, and as we close loans or give you guys money to go out and acquire properties and rehab them, we're able to park them on these securitizations, and as loans pay off, that opens up availability for us to park more new loans back into that securitization. So it's called a revolving securitization. And then our average duration, I think, is about 6 months off the top of my head, roughly, for the bridge loans. Yeah.
That's awesome. Okay. How effective is working with Kiavi for cash only auctions?
Cash only is effective. So it just depends, right? Like, if you're buying cash and then you come back to us and you say, hey, I bought this, last week, all cash, I want to refinance it onto a bridge loan, take some cash out or take some additional cash for rehab, that's something we can help with. Like I said, it all depends, right? Like, if you bought something all cash 3 months ago and you want to put it on a rental loan, we do have some seasoning requirements on the rental loan side for cash out. So that kind of gets into, like, what's your LTC of the property? What's the stabilized value? What is the amount of cash that you're going to be taking out? There's some, that's going to fall in the bucket of talk to your loan officer. That's a pretty specific scenario. But cash purchases is certainly something we work with on a pretty regular basis.
Nice. Similarly, does Kiavi offer a construction loan product if the land is owned? Roger notes that he has multiple lots that are contiguous. Wow, I can't speak. That are contiguous. Wow.
Contiguous.
Thank you.
We do offer construction loan products. That kind of fits in my bucket. That's one of the products that I work on daily. We do have some experience requirements around that, as well as experience requirements around the multifamily loans. I know I kind of touched on those early on, but there are some experience requirements. Happy to, again, find some time and chat through that a little bit more so we can move through some of the other Q&As, but we do offer construction loans.
Lovely. Okay, and let's see here. Kurt says, Hunter, love the content. Thank you. How has the macro environment of inflation and higher rates changed your pricing and terms relative to 12 months ago? And what are your underwriters most concerned about?
It's a great question. The markets have been nothing short of volatile and kind of crazy. 12 months ago was a night and day different world that we lived in. Rates are up today. Rates are higher than where we were 12 months ago. And underwriters probably are most concerned, especially on rental products, with what are the current cash flows today? Do these numbers make sense? And then all lenders right now are really heavily focusing on the quality of an appraisal. So making sure that you are not getting something that's higher than market value, like an appraiser that overshoots the bow. So a lot of lenders are focusing on values right now too. So you might see some lenders are lending a little bit more conservatively today.
Well said. All right. Deshaun asks, how long does an LLC need to exist to receive a hard money loan?
So that's a complex answer. But if you are forming, say you are striking up a new business, right? You have some partners and you're looking to acquire real estate. It doesn't need to exist for any amount of time. If you are adding partners to the entity, that's a little bit of a different story. Again, kind of falls into that example falls into let's talk further. But to answer your question in short, no, we don't have a requirement for that. A new entity being formed, it doesn't need to be existing for X number of months or anything like that.
Delightful. Okay, I'm going to be cognizant of the time. Thank you so much for the questions. I'm going to take one more and then tell you what to do to get the rest of them answered. So Deborah is curious, when a pre-qual letter is considered insufficient, how do you get a TBD approval?
So the clear to close doesn't come until it's truly clear to close. That's a little bit later in the process, but typically what we found is that pre-qual letter is sufficient, right? Like that most folks view that as like, okay, they've got a proof of funds or they've got a pre-qualification letter. We run into it, but not as often, right? Like, and that falls into once you get the approval for the membership, kind of that you're an approved borrower with us, we can get you a proof of funds letter that states that you have available funds of X dollar amount, whatever you're approved for. So that kind of is the second, thing that can help you out there, Deborah, when you're negotiating on purchases.
Fantastic. Well, Hunter, it has been so lovely to learn from you today. Thank you for being here and for sharing all of your knowledge. Guys, if there are any questions that you have left, please reach out to Kiavi. They are the experts. They can help you out in a one-on-one setting, and they're just wonderful at what they do.
Thanks so much, everybody.
Thank you. Have a good day. We will send this over to you within 2 business days.